I'll move this out of the way. All right, welcome everybody this afternoon to the multifamily offer writing workshop. This is a live call. It is being recorded, so if you're listening to this in the archives, please don't try to dial in. If you're on the call right now, I do not have audio capabilities, so if you want to communicate with me, just do it through the question box, and I will, at the end of this call, I will check for questions. I do not know exactly how long this call is going to go because we've never done this before, and you are going to see, different as we do this on a regular basis. You're going to see a lot of different properties and evaluate a lot of different kinds of properties. So you'll see exactly how long it takes. My whole point is that I'm trying to, see if I can show you how you can create and draft an offer in about a half an hour. And so that's what I'm going to be shooting for here. It may take a little bit longer because I'm going to do a lot of talking. Now, what I want to do first is show you the tools that I need in order to make the offer. Obviously, the first one I have is a landlord cash flow analyzer from Doug Rutherford. Best thing in the business. Everyone that I know of that is doing this on a regular basis, we use this program because it takes you from the very, very first step, which is what you're going to see today, all the way through to creating a marketing package for your investors. This software does it all for you. It's really good stuff. So that's number one. Number two is, let me just, obviously, well, that's number one. Number two is, here is the trailing 12 financials for the property that we're going to be evaluating. Then I also have the broker package right here. We're going to go through this first. And then finally, the last thing that I like to keep right handy is my letter of intent. Now, I'm going to fill this out for you as we go through it, so you'll see exactly how I do it. I think this is really going to be the this is what our analysis is going to culminate into, and putting our pen to paper and crafting the offer and then submitting it to the broker. And I don't know right now whether I'm going to submit this offer. I'll tell you a little bit about it, but we'll see how it goes. And maybe part of this workshop process is to make the offers and then work them through the process. This particular property is not exactly the type that I am looking for my portfolio, but hey, what the heck? Nothing ventured, nothing gained. If you make offers, you move up the food chain with the brokers. They know that you're a guy of action, a woman of action. So maybe I will submit this offer, and then in subsequent phone calls next month, I'll give you a follow-up to let you know what's going on with it. So let me talk to you about this property. It's located in South Carolina. One of my oldest friends in the world. This is a kid I grew up next door to up in Nashua, New Hampshire. He's one of the top real estate agents in Charleston, South Carolina, and he is a residential guy, and he knows I'm a multifamily guy, so he's connected me with his guy who does multifamily. And this is the first property that they sent up to us. It's called Dorchester Village Apartments. So the point here, folks, is I've never seen this property. I'm probably not going to go down. I'm going to be doing a seminar down in Charleston in the next couple of months. Maybe I'll go and see it then. But right now, I have no intention of going to see this property. But we're going to make an offer anyway without even seeing it. So let me run through their highlights here just to give you an idea. The list price is $6.1 million. Okay, fine. They're giving us a starting point. Like I always say, the biggest lie in multifamily is the asking price. So he's at 6.1. That's going to help give me an idea of what the cap rate is that he's trying to sell this property at. But it doesn't mean that that's the number that I'm going to be making an offer on. That's for sure. It's 137 units, a C-plus class, and one of the units is an on-site office. It's professionally managed with an on-site manager, a handyman, and then this is kind of interesting, and I really like the way that they've presented this. I just did a quick look at this before I got on the call, but I think they've done a really good job at presenting this. They said, note that in some of the financial statements, some expenses are unique, and a new owner may not have the same charges. All right, well, that's fine. Then they go on to say 8 units entirely redone during 2013 and taken off the market and returned to market in December of 2013. That means that when we look at the income expense, there should be a drop in income prior to December 2013 because these units were not earning any income, and then after December 13 it should have bumped up a little bit. All right, fine. 7 units entirely redone during 2012 and taken off the market. Oh, that's fine, but we're, that's a little ways away. That should not impact the income statement, but what it will impact is the fact that they have 15 units entirely redone. Almost 10% of the units are completely renovated. That's not a whole lot. That's nothing to get excited about. That's not like a full rehab on a property. So, bravo to them, but I don't think that's really going to impact all that much. Now, note this next point here is 4.85 acres. Acreage is not continuous. All right, well, that tells me that when it comes time to work with a lender, I've got to get a lender that's going to be okay with the layout of this particular property. What they like to see is that the properties are contiguous. They touch each other. And if you're looking to buy a property, this Dorchester Village Apartments, it should all be within the same, essentially the legal term kind of is curtilage, actually, all within the same area. But then sometimes you're going to have a property where you've got part of the property on one part of the street and the other part of the property down the street. Now, the lenders don't like to see that. They like to see the properties touching. If they're not touching, the lender may come back and say, you know what, we want to see you're going to have to get 2 mortgages on these properties. You're going to have to go through the whole process, 2 different appraisal fees and what have you, and it's a pain in the neck. So you want to make sure that the lender is okay with it. I see somebody just says that my voice is breaking up. Sam, hopefully it's getting better. This is going to be the if that's going to be a problem, wait for the recording. And it should be fine on the recording. Sometimes it's either your computer or something through your connection with GoToWebinar, but right now it's being recorded to my system, so I'll match it up so the sound is good. Maintenance expense account does include one-time capital expenses. The current owner has been updating the units for several years by building. Please be cognizant that some of the expenses are non-recurring. So what they're trying to tell you is that, hey, our expenses are high because we made the mistake of including them in the operating expenses as capital expenses, and they shouldn't be. Property taxes and insurance are included in taxes and insurance expense. Current owner's hazard insurance runs $50,000 and flood runs $2,000 required on one building. That is the biggest government ripoff lately, is this new flood insurance thing, but everybody's got to do it. Now, the current owner has updated and redone a number of the units, and a large renovation happened in '95 per the previous owner. '95, guys, that's 20 years ago. That's a lifetime ago. Who cares about the rehab in '95? Everything's going to need to be redone. Carpets don't last that long. You will note that occupancy and income are increasing at the complex. Redone units placed in service in December 2013 are being offered for, now remember this number, $700 to $725 per month. Okay? Units are well constructed and the property is well maintained. Property owner maintains a very high level of management with a staffed on-site office. Okay, great. Now, the first number I'm going to grab out of this is, besides the 6.1, are these numbers right here as far as the makeup of the units. And let me show you how I do this. I'm going to jump on over to the cash flow analyzer. I'm going to click on the input data screen. I'm going to change it to multifamily, and I'm going to put in as a contract price $6 million. Okay? That's the only information I'm going to add to this right now. Next thing I'm going to do is go up to the input data, to the rent roll, where I can start building the look of the property. Let me just minimize this and you'll see what I'm going to do here. Hopefully it's going to work. If it's too small for you, bear with me. 1 bedroom, 1 bath. 1 bed, 1 bed, 1 bath. They had 56 of those units. Let me just minimize this so we can try to work it all together. I'll make this larger so everybody can see where I'm stealing this information from. Right there, 56. So 2 bed, 1 bath. They have 66 of those. They do not give me the square footage, so I'm going to leave that number blank. 2 bed, I got 56. I've got 1 bed, 1.5 bath. That's kind of strange. bed 1.5 bath, and I've got 4 of those, and I've got 4 two bed 1.5 bath. I've got 4 of those, and then finally I've got 7 efficiencies. Okay, now here's a problem with the information, the way that they provided it. Actually, I did that wrong. I should just say efficiencies and say 7. So I've got 137 units right there. All right. Know what they don't give you here is what each one of these units is what the market rent of each one of these units is. They only give it to me in the form right here where it says that it's the new units coming online are 700 to 725. Okay, so I cannot put into the spreadsheet the information right here that I need. I need to put in the number of units and the monthly rent, and when I do that, it's going to automatically calculate out my gross potential. But I have a way to back into that number, and it's very important that I do that. So let me jump on over here to the trailing 12. All right, look at the top line number, most important number. We're going to start right here in line 11. The rental income. This is the market rent. Look at lines 11 and 12. They call line 12 the market rent. So I know that the market rents on this property, if everybody was being charged the market rents, it would get to be 78. I would be able to generate $78,320. So I'm going to take $78,320 and I'm going to divide it by 137 units. It comes out to be $572. So what I'm going to do is jump back down here, and in each one of these monthly rent categories, I'm going to put in 572. All right, now watch what happens. If I go back to this trailing 12, in the whole year, $951,000 is the most this property can generate. And if I go back down here to the cash flow analyzer, $940,000. So we're off by a little bit. Let me. Why is that off by that? 940 versus 951. So I'm up by 10,000. Oh, I see why. Because look at what happened. The monthly rent went up. Rental income went up. You know what? Let me do it this way. I'll take the 951. That's the right way to do it. 951.045 divided by 12 divided by 137 is actually. Let's try this again. 951. 045. And folks, all of these documents are on the membership site under the offer workshop button. Divided by 12 divided by 137 is 578. So it actually should be 578. So let me go back in there and change that to 578. And 950. Perfect. Perfect. All right, let me jump on over here to the trailing 12. I think it's important that we start talking about this number right now. I specifically told the broker I wouldn't even start to evaluate this deal unless I had a trailing 12. And make sure when you get a trailing 12, it is truly a trailing 12. That means every single month for the previous 12, I get to look at the income and I get to look at the expenses. I don't care about looking at 3 months of income and 12 months of expenses. That's a bogus report. Always get the full and complete trailing 12. And here they've done it. Now I can tell by the categories. You see how they've got these category numbers and everything is nice and neat. This is a very good property management program that they're using to manage the property. So I know that these guys are doing a very good job in putting this together. Now take a look. What I need to do now is I need to get from the top line number of 951 all the way down to the actual income, rental income that was collected, which was 811. Check that out. If you go from 951 down to 811. How did we lose all that money? where did that money go? Now, the first place it goes is in this thing called loss or gain to lease. Now, check this out. This is really interesting. I've never seen a property that's done this before. They actually, on some of their units, they have a gain to lease, and on some of their units, they have a loss to lease. Now, what that means is that, you know how they said that some of the new units, they're getting 700 to 750 or 725? What that means is that those rents are actually above the market rents. So it's called a gain to lease. And then everything else is below that number. Remember, on average, these units are $578 a piece. And these are now showing up. I mean, their top line numbers, $725 for some of their units. So they've got rents all over the place. Some of the same units are getting different amounts of rent. And so they have to account for that, and they do it right here in this gain to loss to market, loss to lease and gain to lease. And what happens is here they've got a net loss of $3,500. So that's an interesting thing. Now, that's not always good. What that tells me is that some of these units, if the market gets worse, these guys are going to have to drop those rents to compete. So that gain that you're looking at here may end up being, $30,000 out of your pocket, and it's gone. So that accounts for $3,500 change, big deal. It actually goes up by $3,500. Then we take a look at the collection losses. Here are the vacancies. Vacancy loss for down units, and vacancy loss for administrative units. Now, you might wonder to yourself, why do you have two different categories, one for vacancy and one for vacancy loss for down units? Well, think about it this way. If you can't rent the unit, is it truly vacant? In other words, if your property management company gets a bonus based upon the vacancy that they have on the property, if you've got units that are down, that cannot be rented because you have not rehabbed them, should your property management company be penalized in the calculation of the vacancy? Or should they only be allowed to, be charged against those units that can actually be leased? So what this is telling you is they've got some units that they just can't even rent. They are ugly. They have, mold. They're missing appliances. They're, total gut rehabs. We can't rent them. And here's the amount of it. Now take a look. They've really reduced this number over the last 12 months, which is good for them. But ultimately, including the vacancy, what we need to do is take a look at their bottom line number. $811,000 is what they actually collected on their rents. So that means if we go back to the cash flow analyzer, we have to get this 950 down to 811. And the way we do that is by changing this vacancy rate. Now, I'm using kind of the a different methodology here for doing this. This is one of the problems I see with the cash flow analyzer is I can't build in those loss to leases and gain to leases. I can't build in the down unit vacancy. I just have to use a factor that gets me from that 950 all the way down to the 811. So if I put in 10, that's not enough. I got to put in 15. All right, 811. So if I go to 14, I got a 14.5. 812, that's close enough. So what this is telling me is the property is actually running at a 14.5% vacancy. Now, if you go to the broker and say, well, this property is running at 14.5%, the broker is going to look at you and say, no, it's not. This property is running at, a 10% vacancy. Well, in our vacancy calculation, we're including everything. We're including the loss to lease. We're including the down units. We're including the missing, the management unit. We're including all of those things. And what's happening is we're coming up with a number of about 14.5% vacancy, which is not that bad. That's not that bad. All right. Now, the other thing here is take a look at the next category that we are going to count on, which is the other income. Now, what I do here is I look at those types of incomes. I break the income down into good income and bad income. First off, let's take a look at the biggest one there. Late fees. $31,000 in late fees. Now, would that be considered good income or bad income? I consider that bad income. That's killing my cash flow. Not only, you're making $31,000 in late fees. Yeah, but I'm scrambling every month to get my mortgage paid because nobody pays me on the first of the month. And if I capitalize that income, what I'm actually doing is taking $31,000 at a 10 cap, let's say. I'm taking $300,000 out of my pocket and giving it to the owner so that he can, go down to Tahiti, and I'm going to pay that $300,000 back because I capitalized the bad income. I bet I'm going to have to evict most of these people anyway, so why would I pay the seller more money for income that I may never really even receive? So that's why I look at that $31,000. I don't even give it any credit. That's how bad I think it is. Look at the application fees, $2,785. Now, the thing about application fees is typically it's $25. An application fee is $25. Take a look at what they did in the first month. Back in August, they had 2 applications. Then we get down here to 480. 480 divided by 25, and you're looking at about 20 applications. So the applications have grown considerably, but that's not really good income. And the real reason is because you take in 25 and you pay out 18 in criminal and credit check costs. So I don't like any of this income that they're showing. What's this forfeit? Oh, that's a great one right here. Forfeit deposit, $1,500. That means that the people skipped on you and you got to keep their security deposit. Doesn't mean that it's good, because typically that type of a income comes with a corresponding expense in the form of a turnover cost. So all of this other income I don't even like. I'm not even going to add it to the list. I'm not going to include it right here in the spreadsheet under other income. You see that it would fall right under these categories here. I put it in and it would automatically calculate up into this number. Actually down here under, it shows up on the cash flow analyzer, the CFA component. And just so everybody understands, there are 137 units here. So when you're over here by the number of units, you don't go down here to the up to 150, because look what happens. It drops everything way down. That's not what this number of units category is for. The number of units means the number of types of units. Now we know that there are 5 types of units, so we're going to go with the up to 10 category. And same thing down here under the other income. You drop it down to 3, and it cleans it up a little bit. It's more aesthetics, more easier on the eyes, but that's it. So that is the extent of my income, right? I mean, let's take another look here. And for the collection losses, other income, that's renting expenses. Now we're getting into the expenses, and that's it. So, yeah, that's I'm done. I'm done for the income. Now we've got to move over to the expenses. In the 5th month, when I talked to you about the understanding financial statements better than your accountant, I do a whole category. Obviously, I do a whole video on expenses, and the key things about that are the fact that I show you expense ratios. I talk about good income, bad income. I talk about rules of thumb for the expenses, and we'll go through some of that right now, but let's get started, because I want to show you how quickly you can go through this once you know what you're doing. Now, renting expenses, look what they're actually talking about by renting expenses: advertising, promotion, dues and membership, parties and gifts. So these are really marketing expenses. They call them renting expenses. I call them marketing expenses. They spent $25,106. I jump back over here to the expense category, and under advertising, $25,106. Done. Then I go back here. Let me see if I can minimize each, and we'll see if we can put them together. Oh, wait, I know I did it the wrong way. And yeah, let's see if unfortunately, because of this GoToWebinar thing, it's going to be frustrating. Let me see if I can. Yeah, it's not going to work for me. Okay. Sorry about that, guys. Let's see if I can do it a different way. There we go. All right. So let me jump back over here to the next category. Next category, administrative expenses. Now they've got in here office payroll, negative $44. That's kind of interesting. Management fees they've got built in here of $31,282. Bonuses, legal expenses, pager, beeper, bank charge, bad debt, professional fees. That's interesting how they've kind of thrown all of these things together. You know what? I'm just going to stick, just for the sake of keeping this easy, I'm going to take the administrative expenses. I'm going to lump them all together like they did. 137,352. I'm going to jump back over here. I'm going to change this to administrative. 152. Now understand what I did. Because you can change these categories, do that now. Change the categories. Make sure that this spreadsheet looks exactly the way you want it to, because if you decide to go forward with this deal, you've already built the basis for your analysis and the basis for your management, your marketing tools going forward when it comes time to raise money to do this deal. So make sure you put it all together correctly. All right, so administrative operating expenses, what do they have in here? As you can see, they've got some utility expenses built in here as well. They have not broken them out. Electricity, water, sewer. Nice thing about this is the electricity is very low, which right away tells me that this is a tenant-paid property. Means that the landlord does not pay the utilities. That's nice. That's the only type of property I buy nowadays. And it also has garbage removal. So under the operating expenses, they've got 82,817. Here we go. Okay, jump back here. And we're going to say administrative. No, what do we say it was going to be? Operating at 82,817. And we get operating at 82,817. Next category that we have here is maintenance. Okay, 9647. See, the problem with what I'm doing here is that I'm not going to be able to share with you how these numbers look on a rules of thumb basis. But we're going to have it come down so we are going to be able to analyze it based upon an expense ratio basis. So that we'll have to work on that the next time we do one of these workshops. Where was I? I got maintenance at 9647. Maintenance at 96,487. Okay. Insurance at, holy cow. Oh, now check out this. They've got the insurance loss expense of 257 and then insurance loss proceeds of 2. So they had a huge claim. They had a huge claim. We'll have to find out more about that. Property tax. Oh, you got the taxes in here as well. Yeah, so that's going to be $174,000. Yeah, that's about it. But we got some payroll expenses thrown in here as well. So this is really, you'd have to go back and really rebuild this financial statement based upon the different categories. I'm sticking with their categories right now. 174,877. 174. I'm just going to throw this under insurance. 174. All right, that's it. So I've got $516,000, 439 of expenses. Let's take a look how it looks. They've got total operating of 516,639. 516,639, 516,439. Close enough. Okay, so we are right in line. Now take a look here at the expense ratio. This property right now, based upon their numbers, is running at a 63% expense ratio over the last 12 months. All right, guys, let me tell you something. That's not good. This is a tenant-paid property. It should be closer to the 55% expense ratio. The fact that it's at 63, where the tenants pay their own utilities, now granted it's a C-plus property, and you know, everybody looks at this. Don't look at this and think, oh, look how much money I'll be able to save if I get it down to the rule of thumb expense ratio. I can get it down to 55% and save 10%, $50,000 on the expenses. If this guy can't run it at 55, what makes you think you can do it at 55? 550,000. So this 63% expense ratio, remember the notes that broker gave you at the beginning saying, oh, well, you got to take into consideration some of these expenses are capital expenditures. They should be carved out. Yeah, all right, fine. That's your problem. You're showing it to me at this number. It's at 63% expense ratio. Doesn't look all that good. All right, so what we need to do now is jump back over here to the input data section. And I'm going to scroll down. First number I'm going to look at is an 8 cap. All right, at an 8 cap, this property, based upon the NOI, is worth 3.7. They're looking for 6.1. I'm coming up with 3.7. Now, if we change this, if the market is actually, or we're looking to buy these properties at a 7 cap, the most we can offer is 4.22 million. That's it. And they're looking for 6.1. You know, and remember, guys, don't be embarrassed by the fact that they want 6.1. I bet they would settle for 7.1 too. But the fact is, it only is worth 4.2 at a 7 cap. And if it's not a 7 cap, but if it's a higher cap rate, you know, then you're looking at even less than that. I mean, the thing is, I need to get down there and talk to the broker and say, hey, tell me what cap rate are C plus properties trading for down in that marketplace. And if he tells me 8, then my offer has to be 3.7. But right now it's at 7%. At 7 cap, we're just using for an analysis, and we're looking at 4.28%. So I'm going to come back up here, and I'm going to put $4.28 million. All right, that's the number. Now we look at the financing. 25% down. My interest rate's probably about 4.75, I'll say. We're going to go with a 25-year amortization, and that's what we do on the mortgage. 25% down. We're going to do 4.75% interest rate, and we're going to do it over 25-year AM. I don't use the 360. I don't use a 30-year AM because this is an older property, and you know some of the lenders are not so inclined to give a property like this a 30-year amortization. Let's see here. I just want to check some of the questions. Your voice, you just lost. Audio is back. Hi, Charles. Don't have access to the analyzer. Okay, Ronnie. Ronnie, send me an email, Ronnie, offline on that particular matter, and I will get that taken care of for you. All right. So there we've got the financing all set. Now here's the $1 million question, folks. Here's how this works. I'm just trying to figure out how to. I can minimize that, and I can't. All right, here's what we do next. We come up here and we click on the CFA. Now this is the tell-all. Now some of you may look at it and say, like, well, what's this red number? Well, the red number means that if I were to buy the property at $4.228 million and sell it at the end of the first year, I would lose $106,000 because I have to pay all the seller commissions and I have to pay the closing costs and what have you. So I can't sell this thing and make any money at the end of the first year if I buy it for $4.28 million. All right, let's take a look at the debt coverage ratio. 1.36. I don't know about you guys, but I'm not excited about that. Look at the cash on cash return before taxes, 7.48%. I'm sorry, a C plus property at a 7.5% cash on cash return. I'm not excited about it. It doesn't do it for me. So I got to go back here, and remember what we said with that 8 cap. You know, at 8 cap it's 3.7. Well, let's go put 3.7 in here, and when we do that, and we go back over to the cash flow analyzer, what happens? I only lose $56,000. Okay, now look at my debt coverage ratio, 1.56. That's my sleep number. I feel good about that. My cash on cash return, finally I'm up to double digits. Not that great. I mean, you got to remember, guys, C plus properties are a lot of work. And if you're not getting a good cash on cash return, you might want to think twice about, you know, putting your efforts somewhere else. In this particular case, it's 11.48%. All right, fine. I got the number where it needs to be. And so what I do now is, let me just see, I'm trying to understand why I can't. Okay, thanks, Ronnie. So what I'm going to do now is I'm going to jump on over. First off, let's go back to this. Okay, I think the guy's name is Joel Schapp. It's not my friend. I know my friend's name. But let's see, Owen Tyler Real Estate. So what we're going to do here is I'm going to jump on over here and type in my thing, Mr. Joel. I will check this out before I send it out. I'm not going to send it. Owen Tyler Real Estate. And what are we going to do here? I'm just going to grab this right here. See, copy this. Put it right there. Paste it. Put it. Change it. Match. Unbold it. This way I can make it work a lot faster. Oh, what am I doing? Mount Pleasant, South Carolina. All right, and so I'm going letter of intent for Dorchester Village Apartments. I usually put the address in there, but I'm not going to now just because I don't want to take your very valuable time. But just so you understand, apartments, just so you understand, that's how we do it. Why did I do that? Let me see if I can get this to work, and of course it's not working. I love it when that happens. There we go. There we go. All right. All right, dear. I'm going to call him Joel because I've had a conversation with him on the phone. Please outline how Dobbins Law would be willing to purchase the above reference. This letter will serve as a non-binding letter of intent between the owner of record, seller represented by Owen Taylor Real Estate. Is that the name of the place? I know you're all probably, if it's wrong, you guys are all yelling at me right now. Owen Tyler Real Estate. All right. Owen, no, I got it right. I'll be represented by Owen Tyler Real Estate LLC. All right. Now, purchase price. What do we say? 3.7. Fine. 3.7. And the earnest money, we're going to give him 10% of that. So $37,000. 37 is my dyslexia. Almost cost me a lot of money. And then the down payment. Now, here's what we're going to do is, and now why do we put the down payment in there? Because what we want to do is show that we're a solid buyer. Remember we said it was 25%. So if we did 3,700,000 times 0.25 equals $925,000 minus the earnest money deposit is $888,000. So 88823 and all right. So I'm trying to make that nice and line up perfectly. Never does. Okay, so this is going to give me my first mortgage amount of $2.775. Now, why do I do this? Why do I break it out this way? Because I want to show this guy that I am actually a legitimate buyer, and that I can put down this kind of money, and that I'm coming to the table with some dough, and I'm not buying this property as a no money down transaction, and that I'm a legitimate buyer. And when he sees this, he knows, okay, this guy's got some money to put down, and it's not going to be one of those guys coming out of a boot camp trying to buy things using all seller financing. When I build it into the offer sheet this way, then I know that it's a legitimate offer. All right, so fine. Now, both parties will strive to execute a mutually acceptable purchase agreement within 15 days after the execution of this letter of intent. That means once we agree on the terms, we're going to send these off to our attorneys. They're going to come back and work on a purchase agreement, a purchase and sale agreement, and we have 15 days to do that. Now, let me just tell you something, folks. And all the time that I've been doing this, if you miss that 15 days, it doesn't really matter as long as both sides are working towards getting this thing accomplished. If one party has not moved in 15 days, at the end of 15 days, we're done. We'll just walk away. Forget it. We're not going to do this. So that's what's going to happen over that 15-day period. Now down here, I'm going to say $37,000 will be deposited with the escrow agent within 5 business days after the receipt of all documents listed in the Schedule 1. All right. The date of receipt of these documents shall be the effective date. All right. So let's take a look at this. The refundable earnest money deposit in the amount of $37,000 will be deposited with the escrow agent within 15 days after we get everything, not when we sign the purchase and sale agreement. Fine, we'll sign the purchase and sale agreement, but if you go and you sit on your hands, Mr. Seller, and you don't give me the documents I need, I'm not going to write a check. So if I hold off on writing the check, then you're not going to have any earnest money until you get to work. And believe me, I have done it this way, and I get, some brokers give me pushback on it and say no, but other brokers say, okay, no, fine, we understand it. We will give you everything you need on day one. Great, perfect. Give me everything I need, and I'm off to the races. But I've seen it happen far too many times where you get nothing. And folks, if you get nothing, why should you spend the $37,000 to write a check and put it in someone else's bank account? Have this guy give you what you need. So that's how I work the earnest money deposit timing. Now, the effective date, the purchase shall have, in this particular case, I'm asking for 45 days from the date of receipt of all the documents listed in Schedule 1, that's the effective date, to perform the inspections and examine the records, okay? We all know how the inspection period works. Now, the financing period, I'm including a financing period in here because if I don't like if the bank comes in there and doesn't like this deal, I don't want to have to own it. So I'm going to build it. So I get 45 days for the inspection. Then I'm essentially giving myself another 15 days for the financing. Now, that does not mean that I have a 2-week financing period. I'll tell you right now, before I even make the offer, while I'm doing the purchase and sale negotiations, I'm on the phone with my mortgage broker, and we're strategizing over how are we going to get this deal financed. Okay, so it may seem like there's only 2 weeks between the end of the inspection period and the financing period. Yeah, so what? I actually have been working for 60 days on the financing. And if I can't, I will know within 59 days if I can't do this financing. So it doesn't really matter to me. Brokerage fees paid by the seller. Closing will occur on or after 90 days after the effective date. Now, get a load of this particular train, a hole big enough that I can drive a train through. I always include this paragraph. Should financing constraints dictate additional time, an additional 30-day extension shall be available when? Well, when I write a request. And such written request shall be made prior to the closing date. Well, what happens if the seller rejects my request? Well, guess what? He can't. He can't. All I have to do is ask for it, and I get it. So that's why it's written that way. And then when it goes to the purchase and sale stage, this wording gets written into the purchase and sale stage as well. So it's documented in the purchase and sale. Just a little tip here, folks. If you negotiate this in the LOI and you do not put it in the purchase and sale, it doesn't exist. Don't think you can go back to the LOI and say, well, wait a minute, we agreed on this. You agreed on what's in the purchase and sale agreement. If it's not in there, it doesn't exist. All right, so the seller will pay for basic title, closing cost expenses, and then that's it. That's it. There's my name. I've already got my electronic signature in there. I want the seller to sign off on it on a particular day. So what I do is I come up here, I click on this, I go to prepare. How do I do this? I go to save as a PDF, and I call it, Dorchester Village Apartments, LOI, publish. And then what happens is it's going to pop up. I come up here to File, Send File. And guess what happens, folks? Comes up in my email, and I mail it off to the broker. 4 minutes and 43 seconds. I mean, it's 4:44 right now. It took me 44 minutes to put this offer together. Is it going to get accepted? I don't think so. They're looking for 6.1, and I'm offering 3.7. But you know what? 3.7 works for me. And I'll call the broker before I send this over and say, hey, listen, I took a look at this deal. Here we go. See, retry. I don't know why it always does that. But, I took a look at this deal, and the best I can come up with is 3.7. Wow, that's crazy. No, it's not crazy. Those are your numbers. You're at 63% expense ratio on a tenant-paid utility property. Don't tell me it's crazy. Well, no, you got to reduce this. You got to change this. No, I don't. I'm looking at your numbers. I'm using your numbers. Tell me how I can get to 6.1. What do I need? This thing has to be a 3 cap for me. Yeah, let's figure that out. Where are we going? What does this property need to be on from a cap rate standpoint in order to be worth 6.1 million? Yeah, about a 5 cap. Maybe a 5 1/4. No, 5 1/4. I got to go 4.75. Sorry, I went the wrong way. Yeah, it's got to be a 4.75. And see, here it is, folks. Charles Dobbins. I send it to myself, and there's my LOI. It's all locked down. It's in a PDF format, and I'm done. And that's the end of it. So let me just take questions right now. What happens, Ronnie? What happens if they want to counter? Then that happens, Ronnie. When that happens, it kind of reminds me of the old insurance days. I worked for this company where we sold this unique form of insurance, and if somebody accepted our offer, right away we thought we did something wrong. If they want to counter, fine, let them counter. Remember, there's three things that happen. They can reject, accept, and count. Well, actually, four things: reject, accept, counter, or keep their mouth shut and never do anything. And if they want to counter, fine, have them come back. But if I'm at 3.7 and they're at 6.1, if they come down to 5.5, what's my 3.7 going to go up to? 3.8. That's it. My 3.7 is a legitimate number. I'm not going to split the baby with these guys. I never split the baby with anybody. 3.7 is a legitimate offer based upon their numbers. So the most I'm going to come up is 3.8. If they come down to 5.5, let's say, and I'm at 3.8, we're still too far apart. But the thing is, I made an offer. I made an offer. What did it cost me to do this? Nothing. If anything, this broker and I are now friends. He knows I make offers. He knows I know how to evaluate properties. So that's the thing that you got to really think about, is you're just throwing stuff out there and you're putting yourself in the stream of commerce. Now, I had one client call me up the other day and said, well, this broker said that my numbers are all coming in way too low, and that if we're looking to buy properties at that particular level, then the broker is going to want to invest in my deals. I said, great. Why doesn't he invest in this one at the price that he's selling it at? And the answer is he won't. He absolutely won't, because he knows that price is too high. Biggest lie in multifamily is the asking price. Okay, next question. It would be helpful to see what ratios make sense to use as a benchmark. Cash on cash, cap rates, internal rate of return. Okay, let's talk about this for a second. First off, what ratios would make sense as a benchmark? Cap rates. No, cap rates are based upon, in my analysis on my 5th month video, Understanding Financial Statements, I talk about cap rates, and I really, and I apologize for this, I really dumb it down. Cap rates, when you understand how cap rates are calculated and what they're used for, they get very, very technical. So I'm not going to get into that level just now. But what I'm saying is that you need to understand what cap rates your investors are looking to invest with, and then go out there and look for those types of deals. All right, you cannot use a benchmark or a ratio for cap rates. That's different for everybody. Now, cash on cash, this is the thing about cash on cash. Different quality assets will require different cash-on-cash returns. If you're looking at an A-class property, don't expect a double-digit return on an A-class property. You're buying quality. You're buying a good, solid investment. You're buying like a government bond. And what does grandma get with her government bond? She gets like 1 to 2%. So if you're looking at a good quality, solid A-class property, that's like a government bond. Don't expect a 12% cash-on-cash return. But if you're looking at a C-class property that comes with tons of risk, don't buy it at a 4% cash-on-cash return. That's just a stupid investment. So you've got to understand the cash-on-cash return based upon the type of asset that you're looking for, and everyone's going to be different. All right. Let's see. Would it be better to offer a lower offer in order to get to 4.2 when they counter? Well, at 6.1, these guys are not going to counter at 4.2. I'm at 3.7. Now, the thing is, and I think I understand where you're coming from on this particular question, 3.7 is the number that works. But in their mind, they're going to see a 3 with a 3 million. And that's going to mentally say, no, these guys are way too low. Would it be better if I came back and made my offer at a 4.1 or something where the number in the front is a 4? Well, what happens if I do that? Let me scroll up here. Let's say if I make this property a $4 million offer, all right? How does that impact my cash flow numbers? Let's see. Well, I got a 1.4 debt coverage ratio. That's not great. I don't like that. I got a 9% cash-on-cash return. That doesn't do it for me. So, I'm telling you guys, 3.7 is the right number. If you're looking to do this deal, 3.7 is where it should be. That's the best I'll go out with. If they come back and laugh at me, I'm like, what, are you kidding me? You're trying to get 6.1 for that thing? That's ridiculous. All right, so let me see. I just want to make sure I'm answering. I have one more question, so if anybody has any more questions. and I'm going to shut it down. Okay, here's a question. From your experience, how many LOIs do you submit for every offer accepted? Okay, guys, this is a sales business. I don't care what anyone tells you. The most successful investors I have met in this business are the people that came with a sales background. They understand that it's all about the numbers. The more offers you make, the more likelihood of you owning a property. If you make one offer a year, don't expect to own a property. Now, typically what you say, you know, I'm going to go back to my old insurance days, but this is pretty darn similar because sales are sales no matter where you go. You look at 100 properties, you make 10 offers, you get 2 accepted. So you look at 100, you whittle it down to the 10 that you want to make good quality offers on, and then you're going to get 2 of those 10 accepted. So, you know, what does it take to look at 100 properties? You can do, you know, you can do 20 to 50 in a weekend. But the thing is, are you going to make offers on all of them? Well, you know, I'll tell you, you saw how much it took 45 minutes to write this offer. You're going to make an offer on 100 properties. It's going to take you forever. You're going to really use your best judgment to think, okay, my cash investors are looking for this type of property. And when I finally come across them, I look at 100 of them and I find 10 of them that meet my investors' criteria, I will make 10 offers. And that's going to take you, you know, about, you know, 7 hours to do that. And that's how it works. It's a numbers game. 10 offers made, two of them get accepted. So hopefully that answers your question. All right, somebody just jumped in again. Thank you. Shows was okay. Good. I'm glad that you guys like this. The other in good income and bad income. Yeah. Well, when you get to this, you get to the 5th month of the masterclass program. The understanding the financial statements videos, I've got 4 videos in there. And let me tell you something, folks, it's going to be a couple hours for you to go through that. Save them, record them, take great notes because there's so much information in those 4 videos. But I break it down into, you know, understanding the financial statement, the introduction to that. Then I do a whole video on income, and I do a whole video on expenses, and then I do a final wrap-up video on the triumvirate, which is the you know, the cap rate, the NOI, and the purchase price. And I help you understand how those 3 numbers come together, and how all of the numbers come together. So all that information about good income, bad income is in that spreadsheet. Yeah, okay. Well, listen, Mike just said, remember, your analysis didn't seem to include the need for renovations. You're right, it didn't. I didn't see much in that particular property package that said I need to do a whole lot of renovations. If they came right out in the property package and said that, then I would include that in there. What I don't do, and take this to the bank, guys, I've never written an offer where I've asked on the initial offer for a, what do they call them? Somebody help me out here, because, you know, that guy Dave Lindahl does it all the time on all of his. He wants a 3% repair allowance. I never ask for a repair allowance in my offer, especially if I've never seen the property. But some of these guys go out there and they ask for a repair allowance right out of the gate, and they ask for 3%. And you know what the seller should do if he sees that? He should accept it right away, because now you're done. Don't come back asking for any more money. Don't come back after you've done your due diligence saying, hey, that 3% is not going to be enough. Tough luck. You asked for it and I gave it to you. That's it. Take it or leave it. So I don't ask for the repair allowance right out of the gate. I wait until I've done my due diligence. Then I go back to the guy and I show him how ugly his baby is and how much it's going to cost. So that's why I don't put that in the initial offer. I mean, this initial offer is really just a way to get started talking to these people. And that's what you want to do. You really want to start talking to these guys and make it happen. So, all right, that's pretty much it. We're coming up on the end of the hour. What I'm going to do is I'm going to save this cash flow analyzer Excel worksheet. I'm going to put that up on the on the membership site. I'm also going to include the PDF of the LOI that we completed. The broker package is already up there. The trailing 12 is already up there. And I'm also going to have the video of this call up there as well. And once we do that, you will have all of the information. If you ever need to go back and see how we did this, you have any questions about it, go online there and check it out. Or, guys, just send me an email, info@multifamilyinvestingacademy.com. That's what I'm here for. I want to make sure you guys do this business right, but I also want to make sure that you're making offers. If you're not making offers, this is nothing more than a very expensive hobby. This shouldn't be a hobby. This is a way that you guys can get out of the rat race. Make it happen for you. So, all right, everybody, thanks so much for your time, and we will talk later. Thanks. Bye-bye.